The Federal Reserve just made its latest move, and it caught a lot of people off guard. For the third meeting in a row, the Fed has decided to hold rates steady, despite rising pressure from the White House and clear signs of economic turbulence. But here's the big question: what happens next? In this video, I'm going to break down today's Fed decision, what's driving their strategy, and how smart investors are positioning ahead of what could be a volatile summer. What's up everyone, I'm Robert, and welcome back to The Alternative Investor. Today's video is all about the Federal Reserve's May 2025 meeting, and why their decision to pause rate changes might be more important than it looks. We're going to dive into what Jerome Powell said, what's happening behind the scenes with inflation, employment, and tariffs, and how this all ties back to your portfolio. Stick around to the end because I'll also share 3 sectors I'm watching closely in the wake of this decision. As of today, the Fed is keeping interest rates at 4.25% to 4.5%, exactly where they've been since late 2024. That marks the third straight meeting without a change, and it sends a very clear message. The Fed is in wait-and-see mode. The central bank is walking a tightrope. On one hand, inflation has cooled, but not fast enough. On the other, the economy just shrank for the first time in 3 years. The Fed doesn't want to hike and make things worse, but they're also not ready to cut, just because political pressure is rising. One of the biggest new variables? Tariffs. President Trump's newly implemented trade policies have sent shockwaves through the economy. Supply chains are tightening, consumer prices are rising again, and businesses are pulling back on hiring and investment. These tariffs are already being blamed for the first quarter economic contraction, and they've added a layer of uncertainty the Fed didn't plan for. Powell even mentioned in the press conference that the Fed is concerned about policy shocks outside of their control. Translation? They're not going to react quickly until they understand how deep the ripple effects go. Here's where things get tricky. April's jobs report came in better than expected, 177,000 jobs added. On the surface, that's good news. But when you zoom in, some districts are starting to show signs of weakness. Companies are slowing hiring and wage growth is leveling off. The Fed sees this and knows that aggressively cutting rates now could reignite inflation. But waiting too long could tip the labor market over. It's a balancing act, and every press release feels like threading a needle. Now let's talk about what everyone wants to know. Will the Fed cut rates this year? They've left the door open, but only slightly. Powell made it clear that any cuts will be data-dependent and that they need more evidence inflation is sustainably moving toward the 2% target. The current base case? 2 rate cuts later this year, likely in the third and fourth quarters, but only if inflation cooperates. So don't expect a June surprise. Instead, watch key inflation reports, GDP revisions, and labor market data. Those are what will shape the Fed's next move. So what do we do with all of this? Holding rates steady, rising tariffs, and mixed jobs data paint a picture of uncertainty, but that doesn't mean sitting on the sidelines. Here's what I'm watching right now. First, financials. Banks tend to benefit when rates stay elevated, especially regional banks that are adapting well to the new normal. Second, energy and commodities. If tariffs keep pressure on supply chains, hard assets could outperform. And third, dividend-paying stocks and REITs, which may regain traction if the Fed signals cuts are coming later this year. We're in a market that's shifting from aggressive growth to defensive positioning, but that's where the best opportunities often emerge, when volatility creates mispricing. Today's Fed meeting might have looked uneventful on the surface, but it's a turning point. The Fed is hitting pause not because things are stable, but because they're uncertain. Inflation, tariffs, and political pressure are all colliding. And that makes this one of the most important periods to stay informed and stay nimble. If you found this breakdown helpful, hit that like button and subscribe to The Alternative Investor for more insights on market moves that matter. And let me know in the comments, do you think the Fed will cut rates this year? Or are they bluffing?